The date is December of 2017, and I feel like a genius. I am making money hand over fist, and the market is doing exceptionally well. But I especially feel like a genius because I am making way more money than the overall stock market. Because I, as a new trader, had discovered something called short volatility. And I had learned that volatility is something that naturally bleeds out of the market after it spikes, which means that if you short volatility, you are guaranteed to make money. And the best part was I didn't even have to short volatility myself because I had discovered a fund called a short VIX ETF that would do the shorting of the volatility for me. And like clockwork, every single time volatility spiked, this fund would drop significantly in value. And that's when I would plow more money back into it because I knew volatility bleeds out of the market. And so if I'm shorting volatility after a spike, I'm guaranteed to get rich. And for a while, that's exactly what was happening. Every time volatility spiked and this fund dropped, I'd plow more money in and it would spike right back up afterwards once the volatility bled out of the market. That is, until it didn't. Just a few months later, we had significantly higher levels of volatility in the stock market, which meant this fund had dropped significantly. But I knew how this thing worked. I knew that that was the time to plow the money in because that volatility would go away and this thing would head back to the moon. And on February 5th of 2018, Volmageddon hit the market. The volatility index spiked to a high of 50, and overnight, this fund lost 90% of its assets from its all-time high just a few months earlier. Now, while this was happening, I was literally refreshing my phone over and over and over again with that sinking feeling starting to cement itself in your stomach, thinking, oh no, this isn't how it's supposed to work. I'm supposed to put more money in when it drops and it's supposed to go back up. For some reason, this thing keeps on going down. What is happening? I woke up the next morning completely obliterated and I had lost about 50% of my portfolio on this trade. And for those of you who have been watching me for a while, this is a different story than the time where I lost 90% of my portfolio on a single trade. If you have a thick enough skull, sometimes it takes you a few times learning the same lesson before you actually learn to apply it. Now, I was devastated and I was really not looking forward to telling my wife what had happened, but I called her on the way home and I told her what I had done, how much money I lost, and she just said, okay. I was like, what? Aren't you mad? She's like, well, yeah, but at least you were trying and you're gonna learn your lesson, you're gonna do better next time. And somehow that made it worse. You know, if you do something bad, some part of you wants somebody else to get mad at you for it so that you can have some righteous indignation and have something to argue against. But she was okay with it, which made it all the more painful for me. But that's not even the worst part. So the next day I go in and I start talking about it to one of my older friends, veteran trader, and I was like, hey man, well, how about that spike in volatility yesterday? And he just said, oh, that was amazing. I've been waiting for that to blow up forever. I was betting on that to happen and I made 300 grand overnight, literally max gain, best case scenario. So I wasn't gonna tell him that I was on the other side of that trade and that I got blown up, but I just started asking him questions. I was like, man, what do you mean you were expecting that to blow up? What do you mean you were betting on that to happen? And so he explained that anytime you have a strategy that is making a good amount of money by betting against the odds of something taking place, it doesn't actually matter what the odds are. If the maximum loss is significantly larger than the potential maximum gain, you are setting yourself for a potential blow up. And to put this in perspective, that fund has never recovered to this day. And there were other funds that actually had to completely shut down because, again, they were betting against volatility, making a little bit of money on a really high probability trade, but in the off chance that it goes against them, they get wiped out. And wipe out they did. Now, everybody's got investing mistakes in their past, and it can haunt you in the back of your mind with the question, what if? What if I would have known? What if somebody would have talked to me? What if I could go back and tell myself, hey, you're about to make a big mistake, or you could listen to the veteran and take the other side of the trade. Well, the reality is I am that man from the future coming back to you right now, telling you you're about to make a big mistake, because we see a similar trade unfolding in the market right now, just on a much grander scale. And many new traders and a huge amount of money flowing into funds is currently participating in this sucker's bet. The difference is the blowup hasn't happened yet. Actually, that may not be true. The flash crash may have actually already begun. Let me explain. If you notice, my shirt is a different color right now. The reason why is because it takes me about 10 to 14 days to put a video together from idea to publication date when it goes up on YouTube. I spend about a week putting the video together, researching it, getting the charts, getting the materials, getting my outline put together, and then my team has about a week to edit it and put all the animations together and the graphics and go back and forth, make sure it all looks good until it finally goes up on YouTube. The problem is sometimes some urgent things happen in the market and it makes sense to try and push a video out much sooner. And that's exactly what happened here. Because all the way last week, I decided it's probably time to start warning people about a flash crash that a gamma squeeze might be causing in the stock market right now. And I just assumed that a week and a half would be enough time to get that out. And currently, what it looks like the stock market is doing maybe means that the flash crash has already begun. So I decided it was in your best interest for me to push this video out with as little editing, with as little graphics and animations and fanfare as possible, so that you have enough time to make a decision and adjust your positions in your portfolio accordingly if you so choose. So apologies for the rest of the video. I'm going to be talking about this in future tense, but just remember, it's possible what I'm talking about has already begun. So what exactly is happening in the stock market right now that is setting it up for a major flash crash? Well, it's called a gamma squeeze. And we're seeing a close cousin of that short volatility trade unfold across the market right now, just on a much larger scale with much, much more money than before. So what is this gamma squeeze happening in the market right now that could cause a flash crash at any point? Well, first take a look at this chart. This shows you the number of assets in dollars that were in short volatility exchange traded products back in 2018 when I and many others got completely wiped out by the spike in volatility. At its peak in 2018, this trade had about $3.6 billion in it. You can see that has significantly declined now. But as you can see from this chart, that trade has been completely replaced by a booming new strategy of money flowing into options income strategies, totaling at last count over $63 billion. Now, obviously $63 billion is a lot more than $3 billion, and that explosion and blow up wiped out individuals, wiped out hedge funds, and bankrupted some people. So if there is any relation and any similar sort of risk in the current strategies involved in the market, then a $63 billion flow of funds would logically represent at least a little bit more systemic risk. There's some nuance with this strategy, but I'm going to explain it very simply. Every time the S&P 500 drops, a bet is placed that the market will recover. This is done by selling puts. This is an option strategy where you get paid income to bet that the market will go higher. The way that options work, just like stocks, if there's a seller, there also has to be a buyer. But right now, the vast majority of money using options on the stock market is selling. And so the question is, if everybody is selling, then who is buying? Well, the answer is market makers, because that's the job of a market maker, is to make sure that there is a market in the security that they're a market maker for. The problem is they're not making their money by taking directional bets on the stock market. So yes, they're gonna buy that put from you if there's nobody else that they can match that trade up with. But that means they have to hedge their bet. And how do you hedge a long put? By buying shares, which means every time the stock market dips and then all the traders and institutions start selling a bunch of puts, it means the market makers have to load up on shares, which pushes the market up higher. And the trading volume in these US equity options surged to a record in 2023, mostly on the backs of 0-day until expiration options. Now, 0-day until expiration options are exactly what they sound like. They are a bet that expires at the end of the day. People are lulled into a false sense of security with these because they think they have less risk simply because there is less time in which something can move against them. As a result of it being lower risk, they're also accepting lower income per bet, which means if they want to make real money, they have to do more bets. And it's not just individuals. To get that massive amount of money into the same strategy, you're looking at institutions and you're looking at retail ETFs, which means that individuals who don't understand the strategy are plowing money into these funds, and these funds are just automatically participating. And the growth has been staggering. At the end of 2019, there was about $7 billion in these derivative income funds. And now there's about $75 billion, with about 83% of that in ETFs. Now, people get sucked into these funds because it looks like a guaranteed way to make risk-free money, producing 5, 10, 15% dividends each month, and the price of the fund just kind of chugs along like normal. It seems too good to be true. And this is important. If you're looking for a detailed rundown of how to profit off of this situation and many others like it that are gonna come down the road, then I want you to save the date on the calendar this Thursday, April 25th at 7 p.m. Eastern time. I'm going live for an asymmetric trading masterclass. I've been using asymmetric trades to take home massive returns in my own account over the last 8 to 9 months. After testing it personally, I released it to a small group of beta testers. And on Thursday, I plan to share everything I've learned with you, from how to profit from this gamma squeeze that's going to cause a flash crash, to rising inflation, rising rates, and a spike in volatility from things like geopolitical uncertainty and the elections. I'm even going to do a live Q&A at the end of the call in order to answer any questions. This masterclass is completely free. All you have to do is sign up by clicking the link in the description below and entering your email. By the time you're watching this video, there may only be a few days or even a few hours left to sign up, and spots are filling up fast. So click the link below, and I look forward to seeing you at the event. Now, I want to provide a devil's advocate argument here, because I'm not saying that the market is destined to have a crash from this. Just because somebody is selling these options doesn't mean there is a massive unhedged base here. A large percentage of this money selling options could be hedged with either cash or shares on the long side or the short side. But one of the big problems with this is that this market is very difficult to see through. Much of this trading takes place on Wall Street, on trading desks, and this information is not available to the public. And remember, a breakout in volatility was able to take a $3.6 billion strategy and cause players like myself and entire hedge funds and entire retail ETFs to go bankrupt. And so if even a small percent of the massive $63 billion participating in this strategy right now is unhedged, that's a recipe for a flash crash. Regarding this strategy, a portfolio manager at QVR Advisors, which is a volatility hedge fund, said that when you're seeing something going on publicly, there's probably 5 to 10 times that amount that's going on privately that you can't see directly. These types of strategies where you make a very small amount of money and there's the potential for a large loss, but I'm smart enough and I'm not going to get anywhere near that. These types of strategies happen every couple of years and they suck money in until they blow up. This has happened over and over and over again. You can go back to even long-term capital management, one of the original market blow-ups that almost took out the entire financial system in the late 90s. This was run by extremely intelligent people who had won the Nobel Prize for economics, literally the guys that the options Black-Scholes pricing model is named after, and it was guaranteed income, but you had to make just a little bit many, many times. And yes, there's technically a risk of blow up, but we're smart enough, we're not going to get close to that. And when they did blow up, it almost took out the global financial system. And what's happening right now is no different. This is exactly the sort of sophisticated, highly levered trade that everybody plows money into because they assume that the guys running it are math whizzes and that we don't need to worry about them blowing up because they're hedged. Now, just because the exact strategy has moved from short volatility directly into the broader market as a whole doesn't mean there aren't still bets against volatility indirectly. In fact, Ambrose Group, which is another volatility hedge fund, has looked at their own internal measure of volatility on the S&P 500. And according to Chris Sidial, which by the way, if you're not following him on Twitter, he is a great follow at KSIDIII. He said the net short volatility exposure is 2 times larger than in the run-up to the 2018 Volmageddon. And ever since 2020, when the market blew up, we've seen continued suppression of volatility in equity markets. We've seen volatility continuously and persistently much lower than you would expect, given all the things that should move the market. And no, this is not the rantings of a bear who's salty about his puts expiring worthless. This is an actual measure of, hey, these things have moved the market in the past, and we're seeing evidence that volatility is being suppressed. But not by some conspiracy, it's by the actual trade itself. Betting against volatility, enough money going that way actually suppresses volatility. Remember, if everybody is piling in to sell puts on every single market drop, that means somebody has to buy shares to hedge the other side of that trade, which pushes the market up farther. It is a self-reinforcing prophecy, a positive feedback loop. Until it isn't. In fact, the rise of yield-enhancing structured products like options income strategy ETFs is highly correlated to the last 2 years with the drop in the VIX over that same period. And now we're seeing signs that smart money is starting to see the writing on the wall and is starting to take the other side of that trade. Right as retail is piling in the most, people who don't understand the strategy throwing cash into these ETFs, Wall Street is turning around and starting to take the other side of the trade. Amy Silverman, head of derivatives at RBC Capital, said that post-pandemic, we've seen a fundamental and technical reasons for volatility suppression. And while it's probably going to continue, it does become more and more difficult to be short volatility from here. Just because something hasn't blown up yet doesn't mean that risk of blow up doesn't exist. In fact, the longer volatility has been suppressed in anything, the more violent the reaction once that volatility rips through the suppression. And right on cue, now we are starting to see hedge funds selling stocks at the fastest pace in over 3 months as they step up their short bets, which is just the kind of catalyst that would be necessary to reverse this trade, unwind everybody, and start the flash crash. Because everybody that was short all of these trades is going to have to unwind and close them out immediately, which prompts the market going down farther. Just like the trade drove the market up, unwinding that trade will drive it right back down. Bottom line is, number one, never invest in something you don't understand. If you can't do a strategy yourself, such as shorting volatility by selling options on the VIX, why would you put your money into a fund that's doing it for you? There is, by definition then, hidden risk that you don't understand. Number two, even if you do understand it, never take a sucker's bet. Never, ever, ever make a trade that has a small potential upside and a large potential downside, no matter what the odds are, no matter how certain you are that that downside would never happen. Because at the end of the day, it's impossible to know the probability. You cannot know the odds. They are never in your favor. And if you decide to take the path of the veteran trader, just understand that most of the time you'll be wrong. For months and sometimes years, you can bet on something happening that structurally probably should have happened already, but for some reason just keeps on not happening. Just like this short volatility fund, every time it started to collapse, enough money rushed back in that propped it up even higher. But the veteran trader understands that to bet against the consensus is just one side of the coin. You also have to be right. And to do that, proper position sizing is key. You can't go all in on a low probability trade, no matter the payoff. In order to make money investing over the long term, you have to make many small asymmetric bets where the most amount of money you could lose is very, very tiny. But when it does win, and that flash crash that you've been waiting for finally happens, you're gonna make way more than you ever lost on all the losers combined. Now, in reality, this is far from the only asymmetric opportunity that exists. Opportunities where your total loss risk is much smaller than your total potential gain pop up all over the market all the time. One of the services that I offer members of Heresy Financial University is hand-picking the best of these opportunities and serving them to you on a silver platter. But if you're not ready for that, I understand. I can teach you how I do it. And that's what I'm doing this Thursday, April 25th at exactly 7 p.m. Eastern time. I don't want you to miss out on that asymmetric trading masterclass. Use the link in the description below, sign up. I'll see you there.